Hello everyone, welcome back to Crack Grade B. So today we are going to continue our series on cash flow statement, the lecture we have started on cash flow statement. You must have seen in the yesterday's lecture that we discussed that what are your operating activities, investing activities as well as financing activities. We also saw some of the examples of these particular type of activities. But let me tell you that in your examination, obviously the whole question will not be asked, but parts of the questions can be asked. Which part of question is most important? Anyone cannot tell you because they can ask anything, right? Right from the accounting standard 3 that is related to your cash flow statement, they can also ask you to calculate cash flow from operating activity, financing activity or investing activity separately. They'll give you some figures and they'll ask you to calculate it. Now it is up to your wisdom that you should know which item you have to include and which item you have to exclude. In order to be able to make that differentiation, you must also be aware about all the items which are going to be there in the operating activity, investing as well as financing activity. Some of the figures, because see, some of the items which are written here, you will not be able to calculate directly. So here comes the formula which we will discuss, right? So what would be the today's discussion? So today I'll be discussing with you formats under both the methods. There are two methods of calculating cash flow. One is direct method and another one is indirect method. I'll be discussing both of them and not just discussing and telling okay this is this thing is there in the format. What I would also discuss is why these particular items are classified into operating or investing or financing, why, what is the logic behind the addition or subtraction which we are doing out of this particular cash flow statement. So once you will understand the whole process, you will understand that okay, what is the format, how it is designed like that, then you will be able to solve any question which will come to your way, right? So I hope this is clear to you. Now let's move forward and see. We are first going to discuss direct method. There are two methods of cash flow calculation. One is direct method and the another one is indirect method. First we'll do direct method. Now one more thing which I would like to tell you over here is, see, so cash flow calculation. Two methods are there. One is direct method and another one is indirect method. Right? Direct method and indirect method. Now what I would like to tell you over here is, in both of these methods, what is the difference? Actual difference is calculation of cash flow from operating activities. You see, cash flow from operating activity is calculated differently under direct method, and here different method for operating activity. right? This is the only point of difference. In both of these methods, calculation for investing as well as financing activity will remain same. What did I say over here? In both of these methods, investing and financing activity calculation in both of these methods, investing and financing activity method will remain same, right? So this is the difference. So we will see how do we calculate cash flow from operating activities in direct and in indirect. Both of these methods, there is no difference in calculation of investing and financing activity. Let's move towards the calculation part. So accounting standard 3, your accounting standard 3 and Ind AS 7. Right? So in older terms, accounting standard 3 and in newer terms, Ind AS 7 is the accounting standards which are related to your cash flow statement. Correct? So whatever we are going to study over here has been prescribed by the accounting standards, which are prescribed by whom? Institute of Chartered Accountants of India. Right? So see, first of all, we will do calculation from operating activities. Now, what we would like to calculate over here, listen to me very carefully. First thing first, I want all the items which are related to core activity. Means whatever activity is my core, whatever is the main objective of my existence of business is my operating activity. So all the items in this particular section will belong to my core activity. First point. Next, those items should be cash items. Because we are preparing what? We are preparing cash flow statement. So all the now non-cash items will be removed. Impact of all non-cash items will be removed. Please remember these two fundamental things when I'll be discussing in further that what all items should be there and what all items should not be there. Please remember these two fundamental things. That first thing, in operating activity column, only those activities, those expenses, those income will be taken care of which are related to the business. And next thing, those all should be cash items. No non-cash items will be included over here. Let's see how do we calculate. So this is a direct method. Direct method means what? What is the difference between direct and indirect method? Let me tell you in a simpler way. So there are two methods which we have. We are calling one as direct method and another one as indirect method. Direct method means what? Including taking all the relevant items. Take all the relevant items and do the calculation. That is the direct method for you. Means straight lane you are taking. Indirect method means filtering out all the non-required items. So this indirect method talks about remove all the irrelevant items. So this will be our motto when we will discuss these two methods. Direct, take all relevant items, ignore the irrelevant items, and there you will be doing back calculation. Here it is direct calculation. Indirect method will call for back calculation. That means you are removing all the irrelevant items. Now see, remember this in mind and see what all you need to calculate over here. See, cash receipt from customers. You have sold the goods, right? Once you sold the goods, you get what? Sales. But that sales figure, it is not necessary that all the sales figure you receive in cash. Some amount you receive in cash, that is your cash sales. Some amount is what you can say is there in your balance sheet in form of debtors. They are going to pay you, but after some time. So direct method calls for cash receipt from the customers. You have to write it over here. This means cash sales if you have done plus cash received from debtors. Both of these things will come here. Because it is direct method, hence I am taking all the things which are relevant for me. So first thing first, I have taken what is my revenue. The income, the money which I am going to receive from selling the product in my business will be from sales. So that's why cash sales plus cash receipt from debtors is my first item. Next is, now I will take all the expenses. So here I will write whatever the cash I am paying to suppliers and employees. The key factor over here is we are talking in terms of cash only, right? We are talking in terms of cash only. If you have purchased something from suppliers but you have not paid cash for it, then you are not going to deduct it over here. Just cash paid. So any cash paid to suppliers along with to employees, right? We pay salary, we pay wages, so that will come over here. If you have any other kind of direct expenses means expenses like which you need to incur in order to run the factory, that is manufacturing expenses. So manufacturing expenses, if you have paid in cash, then you will deduct over here, right? So after deducting such direct expenses, what I will get is cash generated from the operation. That means whatever business I am doing, what is the amount of cash which I have generated after selling my products. I have taken cash sales, I have deducted suppliers payment, I have deducted employees payment. If there is any direct expense which is necessary in order to conduct the manufacturing, then you will deduct that as well. It will give you cash flow from the operation. Now next thing which comes is taxes paid. See, this thing can confuse you in examination. Always remember that it is a operating activity. Why it is an operating activity? Remember this thing. So whenever you are doing sales, you are conducting your business. So government is charging you income tax over that activity, correct? Government is charging you tax over that. So any tax which you have paid on account of your business, means whatever business you are doing, then it will be treated as operating activity. Now listen to me very carefully. I would like to tell you two more points over here. Any tax which you have paid, see, whenever we purchase an investment, suppose I have purchased shares of any company, that is investment for me because I am not a broker. I am not into sale and purchase of shares, right? That is not my business. I have purchased investment just to keep with myself. So that is an investment. Now, if I have paid securities transaction tax on it, there is a particular tax which is applied on the purchase of securities or shares or such kinds of instrument when you purchase. So if there is any tax which I have paid on it, then that tax is not my operating activity, that is my investing activity. So it is very important that what is the purpose for which you are paying tax. Remember this could be asked in your exam. It is a very conceptual based question, like we do not pay much attention on it, and when it appears in the exam we tend to get confused. So please do not be confused and remember this thing, right? So I have told you that taxes will be classified in financing, investing or operating activity based on the purpose for which you have paid tax. Here I have paid income tax because I am conducting some business, I have generated income in it and government is demanding tax on it. So tax payment is being done on operating activity, hence it will classified under your operating activities. Now this will give me cash flow from operations before extraordinary item. Now there can be in any business, there can be any year in which you receive some cash flow which are not regular in nature. Suppose your factory was at Chennai coast, right? So in 2004 when tsunami came, your factory got destroyed, but you were having insurance for that factory. So what you received is proceeds, means you received in compensation from the insurance company because your factory got destroyed. Now factory was what? Factory was the core of my business. I was doing production over there in order to sell my items in the market. So obviously that was my operating activity, and if I am receiving any compensation amount in order to compensate me for the loss of anything which was my operating activity, hence it will be classified over here, and such proceeds will be here, like disaster settlement proceeds you have received, fire, there was a fire in your factory and you received compensation for it, or any other thing kind of compensation which is related to your business, you will classify here under cash flow from operating activity. So this will give you your net cash flow from operating activity. This is what we call as direct method of cash flow calculation for operating activity. I hope this is very much clear to you. I have explained each and every item. What is the purpose of that item? Why do we classify that item under operating activity? So that is it. Now moving to cash flow from investing activity. Remember, be it your direct method or indirect method, there is no difference in calculation of investing activity and financing activity. Both of these kind of activities are calculated in a same way in both the methods, direct as well as indirect method, right? So let's see cash flow from investing activity. Right? So proceeds from sale of fixed assets including from investment. Now tell me, suppose you are purchasing a building, correct? You are not a real estate developer whose business is to purchase and sell buildings, or you are not a property dealer whose business is to sell purchase of buildings, right? You are not that. You are a normal businessman who is doing a business of designer bags. Your business pertains to designer bags, but you are purchasing a building, correct? You have no intention of using that building for the purpose of your business. No, you have purchased that building and now have given that building on rent, and you are receiving rental income from that building. Now imagine this scenario and tell me one thing. When I purchased the building for 50 lakh rupees, that means I had to give up 50 lakh rupees. That's how I will show purchase of building in my cash flow statement, because I will deduct 50 lakhs because the money has got out of my pocket, right? I am receiving rental income on this. I am receiving rent on this. 50,000 per month. That means 6 lakh. This is for a year I am receiving rent. Now I am receiving this, cash is coming in, hence I will show this in positive in cash flow statement. Now suppose after a year or so I decided that I should sell this building, correct? Currently the market of real estate is very high and I should sell this building in order to make extraordinary profits. So what I did was I sold this building for 80 lakhs, and when I sold it, cash came to me. Hence this item will be written in positive. You got that thing? So cash flow means in cash flow statement you have to see every item with the lenses of that whether this price is coming to me or cash is going out of my pocket. This is very important, right? So this is how we will do. This was the example of just one asset. So you will take any other asset, suppose shares. If you have purchased shares, then you have to deduct the amount from cash flow because you had to pay the price. If you are receiving any dividend on that shares, then that is your income and it will be added in your cash flow statement. And if you sold that shares at any particular point of time, that means price will come to you. You will receive the money and hence it will be shown as an addition in your cash flow statement. Now let's see what the format is telling me. So if you have sold fixed assets including any investment, then this item will be added. Why to add? Because money is coming in. If you have purchased something, then obviously you had to pay the price and this item will be deducted. Interest received, dividend received, these are the income. You are receiving the money in cash, hence these will be added. See here very carefully. Whenever you will receive interest, this is your income. As we will move forward in financing activity, we will also see that this can become our expense as well. When we will pay interest paid, dividend paid, that will be our expense and will be shown under financing activity. But any income received is your investing activity. So that's how you can calculate your investing activity, right? Now moving on to financing activities. See, proceeds from issuance of share capital. What we do in finance is we want to have finance for our business. So it will be either in the form of equity, preference or any other kind of thing. That means owner's fund, or it will be in the form of debt. Debt means debentures, loans, any other kind of deposits, right? So these are all what? These are debt funds and these are others are owners funds. So there is always a trade-off which happens between these two, and that's how any business will finance itself. So see over here, proceeds from long-term borrowing, issuance of share capital. If you have issued share capital, if you have issued share to the general public, money will come to you, public will pay to you, hence you are adding it over here. If you have received any loan from somewhere, then money is coming to you and hence you will add it. Correct? You will add the figure, means the figure will be written in positive. Next, repayment of long-term borrowings including redemption of preference shares. So see, redemption of preference shares, buyback of shares, as well as repayment of long-term borrowings. What you are doing in all these three scenarios is you are paying the capital back to the people. Means in buyback, in redemption, you are paying back the money to general public. in payment of borrowings, let's suppose if you have taken a bank loan, you are making the repayment to bank. In all these cases, money is going out of your pocket, and hence I will deduct this item because my cash is reducing. In throughout the cash flow statement, there is just one thing which I have to keep in mind, that whether cash is coming in or cash is going out, right? Next, if you have issued the shares, then you have to pay dividend as well, right? Like we have to pay dividend on preference shares, we have to pay dividend on equity shares. So all these things, interim dividend paid, proposed dividend, right? So all these are what? Dividend which you need to pay. So this will form part of financing activity. Now let me tell you one thing. If these are written in operating activity, so what you should do? Then you should remove this dividend from operating activity and you should bring it into the financing activity in order to correctly classify the items. Because why I am telling you this? Because this will help you to understand the indirect method of cash flow calculation, right? So any dividend paid, any interest paid on debentures, loans, any public deposit, anything if you are paying, so this means the money is going out of your pocket and you will deduct it. Less, right? So net cash flow from financing activity you will get. Now see, you have got three things. You have got cash flow from operating activity. You will add cash flow from investing activity. Then you will add cash flow from financing activity. This will tell you that what is the cash flow during the year. Now you will add opening balance of cash and cash equivalents, and opening balance plus whatever happened during the year, this should be equal to your closing balance of cash and cash equivalents. Am I clear? So whatever is your opening balance of cash and cash equivalents, write it, add in that operating activity, investing activity, financing activity, whatever result you have got, and summation of all these four should give you closing balance. What is the, see, suppose, let's take an example over here, a very short and sweet example. Suppose I had 5,000 rupees in my pocket at the start of the year. My business gave me the earning of 50,000. In investing activity, because I have done the investments, what I have is currently I am short of 10,000 rupees, correct? And in my financing activity, I have raised the finances for 40,000 rupees, right? This means my closing balance, means at the year end, what I should have in my pocket is 85,000. Because 5,000 so I was having earlier as well, and 80,000 is the amount which I have earned during the year. That means in closing, when the year has closed, I should be having 85,000 rupees in my hand as cash and cash equivalent. So this is how your cash balance will match, right? This was opening, this was closing, and this is what all happened during the year. So I hope now we are clear with this. Now let's move to the indirect method of calculation. Indirect method is bit long. Why it is bit long? We will see that. ठीक है. So I have told you that in indirect method, what will change is just the type of calculation we will do for operating activities. Nothing else will change. In calculation of investing activity, calculation of financing activity, both will remain same. Just operating activity calculation will be changed. Let's see quickly how it will change. So this is a back calculation, right? What you have is, when we prepare balance sheet and P&L, in the P&L account, I have last balance, which is the net profit for the year. When I prepare my P&L account, I deduct all the expenses which happened during the year. I add all the incomes which occurred to me during the year. Now remember the line which I am going to say very carefully, right? Listen to me, what I am saying. So when I prepare my P&L account, I do not differentiate between operating, investing or financing activity. I do not. I just see everything as whether it is my expense or whether it is my income. That's it. Right? No differentiation of operating, investing, financing. But in cash flow statement, I need to differentiate. So what I will do over here is, see, in simpler terms, what I will do a back calculation. How we will do back calculation? Let's see. So I'll be having my net profit as per P&L account. I will have this. Now, there will be certain expenses which I have already deducted in here, but I should not have deducted because all those expenses belong to financing activity, right? So what I'll do is, I will add non-cash expenses like your depreciation, which has not been incurred in cash but has been deducted in P&L, right? So I have to add it back because in actuality I have not incurred a single penny. There has no cash which has gone out of my pocket. Hence I will add it. Then expenses which are not operating in nature. Like your interest paid, that is not an operating expense, correct? You have incurred a loss on sale of assets. What did I say? You have incurred a loss on sale of asset. So that is not your operating expense, that is a investing nature expense. You sold an asset, you incurred loss on it, not an operating expense. So just add it back. Why we are adding it back? Because earlier we have already deducted it. I repeat, while calculating my net profit, I would have already deducted expenses like depreciation, interest paid, dividend paid, loss on sale of assets. So all these are not in the nature of operating. So I have to add it back in order to find out the correct cash operating profit. After doing this, I will less. What I will less? There will be such incomes which are or not operating in nature. I must have added that in calculation of net profit. Hence, now I have to remove them. So what I will do deduction is non-operating income. I should remove it. Now listen to me, an example for this is like rent received. You had purchased a flat and you gave that flat on rent. Now you are receiving rent out of it. Your business is not giving flats on rent. You are not doing that. But still you have invested the amount in the flat and you are receiving rent. But tell me, does this rent received comes under my operating activity? No, it doesn't. Hence, I should remove it in order to arrive at my profits. Correct? So, this is the broad thing which will give me what? Two things I am using. Cash, operating profit. Means all those expenses which I have not incurred in cash, I will add them back. All those incomes which are non-operating in nature, I will remove them. I will not take them. So this will give me my cash operating profit. Right? There are two, three more things over here, but we will see that when we'll do our format. Like suppose I am giving you example over here. Non-cash expense. Example, depreciation. So tell me, have you incurred anything in cash? No. Depreciation is just what we have incurred earlier. Now we are amortizing it over the years. In the current year, there has been nothing which went out of my pocket on account of depreciation. Right? No expense has been done in cash. So why should I deduct it? No. I want my profit in cash and operating nature. Although depreciation is operating in nature because you are using the machinery for production of goods, but this is a non-cash item. Apart from it, sometimes you will witness write-off of fictitious assets like goodwill written off, preliminary expenses written off. So these are fictitious assets. You are writing off goodwill over the years. Are you incurring any cash expense on account of it? No. No cash is going out of your pocket. So if no cash is going out of your pocket, then please add it back and give us the cash profit, right? Remove all the non-cash items. So now let's move to the format and see. First thing, net profit for the period before taxation and extraordinary items. So what they are saying over here is you will be having net profit which is given in your P&L. Add in it provision for taxation. Every year we make a provision for taxation. Provision for taxation is separate from the tax which you are paying. Provision means estimating the liability beforehand and saving some amount for it. And actual tax paid is whatever the government has calculated your liability. Right? So provision is calculated beforehand, but making provision is not a cash expense, right? So please add it back. Then if you are having, you have proposed dividend. Proposed dividend means you have not paid in cash, but you have proposed it. Ki, okay, we will be paying 10% dividend. So what happens in P&L is whenever dividend is proposed, a liability is shown in the P&L. Like in your P&L, it will be written as to proposed dividend. Why it is being done? Because of the prudence concept. Prudence concept says to you that please anticipate all the losses and recognize into your books. What it does say? That please anticipate all the losses and future expenses which are going to occur to you and please make a provision for it. So hence we made a provision, but we know that dividend is a financing activity And even in financing activity, we will not deduct proposed dividend. We will deduct the dividend which has been paid. I repeat, we will deduct the dividend which has been paid. Another thing, so there is a provision into your Companies Act that every year you have to transfer a certain percentage of income of your profit to general reserve. So this item also appears as a debit item, as a deduction in your P&L account. So when we prepare our P&L account, all these items appear like this. Wait. I'll give you an example and then it will be clear to you. Suppose this is your P&L account. Gross profit is 1 lakh. Correct? Now, you will show all the expenses like depreciation 5,000, to employee expense 4,000, right? Let's take it in another figures. Employee expenses 10,000. To what else we can do over here? Repairs. You incurred some amount on repairs 10,000. Then you have made a provision for taxation because you know that you need to pay a tax. So this current year you have made a provision for tax for 5,000, right? After that, you have also proposed dividend, means you have promised the shareholders that you will pay dividend to them. 10,000 is your proposed dividend. After that, you are mandated by Companies Act that you have to transfer a certain amount of your profit to general reserve. So you have transferred it. Now the net profit which is remaining with you is, what is your net profit? 10, 20, 30, 40, 50. So 50,000 is my net profit. Now see over here. This profit of 50,000, has non-cash items as well as non-operating items in it. So what I will do is, just see what I am going to do. I will write my net profit here. This is cash flow calculation, right? I will write my net profit 50,000 over here. Now I have tell you that depreciation is a non-cash item. So please add it back. I added it back. Employee expense and repairs are my operating expenses. So let them remain. Provision for taxation. You have not incurred any amount actually. You have just made a provision. So please add it back 5,000. Proposed dividend, first thing, you have not paid that in cash, and next thing, it is a financing activity, not a operating activity. So hence you will write it 10,000. Then transferring to general reserve is not a expense, it is just a allocation of profit. But I want to know that what is the cash amount of profit I have earned. So 50,000, 60, 70, 80. 80,000 is my cash operating profit. What I did was I removed all non-cash items. And see, this is no expense in cash, no expense in cash, no expense in cash. Apart from it, this is not an operating item, this is a financing item, and any dividend which is actually paid in cash will appear in the financing activity. Depreciation is a non-cash item, so that's how we will calculate our profit. So I hope now with this particular example it is clear to you. See, next is you need to do adjustments for non-current and non-operating items. So depreciation is added back because it has already been deducted while calculating net profit, hence we are adding it back. Interest paid, it is a financing activity and hence this should be added back. Foreign exchange loss should be added back because here it is not clear whether this pertains to my operating activity or my financing activity or investing activity. It might so happen I have purchased an asset in foreign. So if there is a foreign exchange loss on it, then it should not be here in my this, correct? Apart from it, foreign exchange loss, sometimes it might so happen you have not made any payment in cash. Earlier your liability was valuing at something else and now your liability is valued at something else, but no cash has been gone out of your pocket. So there can be both the scenarios. It might happen that it is not a operating activity and it can also happen that it is not a cash expense. Hence we are removing foreign exchange loss. If there is any loss on sale of fixed asset and investment, please remove it, because if there would have been loss, it would have been deducted from P&L. Hence, I am adding it back to reach to my cash operating profit. Now, if interest earned, dividend earned, if such incomes you have added in your P&L, please remove them. Why to remove them? Because both of these are my investing activity. I repeat, both of these are my investing activity. If you have made any profit on sale of fixed assets or investment, remove it because it is an investing activity. Now you will get your operating profit. Now this method also includes the changes in your current assets because that also impacts, right? How we will see it. So you will get your operating profit, but before your working capital changes. Now let's see. So you have to add increase in current liability. I'll give you an example. Suppose your creditors. Creditors was what? Creditors is your current liability. Suppose earlier these creditors were 10,000, but this is the last year figure and this is the current year. Last year your creditors were 10,000. This year your creditors are 20,000. Correct? What does this depict? Means my creditors have increased. Why my creditors has increased? Because I have not paid cash. That means I have received the goods but I have not paid cash. So hence I will add the difference 10,000 in cash flow statement, because indirectly this has helped me in the current year to not to shelve 10,000 rupees. Correct? I have not paid 10,000 rupees and 10,000 rupees are still in my pocket. Correct? Hence increase in current liabilities you are adding. Similarly, decrease in current asset you have to add. Why? So example, see here, debtors. Last year your debtors were 15,000. Current year your debtors are 5,000. Your debtors have decreased by 10,000. What does that mean? That means you have collected 10,000 rupees from debtors. It means there is an inflow of 10,000 to you. Debtors decreased means what? Obviously they will decrease when you are able to collect money from them. So in this scenario you will add 10,000 rupees. Now we will just reverse it. If there is a scenario that your current assets are increasing, means your debtors are increasing, you are not able to collect the cash. So in that scenario, you will have to deduct it. And your current liabilities are decreasing. Current liabilities will decrease when I will be making payment. Last year my operating outstanding expenses were 20,000. Current year my operating expenses are just 5,000. Correct? Outstanding expenses. So 15,000 outstanding expenses I have made payment of. Therefore this has been deducted, right? So it will be less because cash has gone out of my pocket. So this will be cash generated from operation. And next you have to deduct income tax paid, right? So you remember we have added back provision for taxation. Why? Because we had not incurred that in cash. So any amount which you have debited in your P&L by the name of provision for taxation will be added back, and thus in this line you will deduct income tax paid. Paid means whatever amount you have paid in cash, right? And any proceeds from extraordinary items, similarly what we have done in direct method, disaster settlement or anything, you will add it back, and this will give you your net cash flow from operating activities. Financing and investing will remain the same as we have seen in the direct method. The only difference between these two methods were calculation of operating activities. I hope you guys are now aware about how the format works, what are the things which we add, what are the things which we deduct. Now what I would like to have from you guys, please remember the formats. Please remember the things, that what we have to add, what we have to subtract, which things are to be classified where, right? So this is it in this class. Thank you very much, and if you guys have any doubt, then please feel free to reach to us, right? Thank you so much, and do not forget to like this video. Thank you.